What if a single moment could wipe out more money than some countries make in a year? Just 1 minute ago, the crypto market experienced exactly that, with over 2.4 billion liquidated in a violent chain reaction that stunned traders across the world. This wasn't a slow breakdown or a quiet correction. It was sudden, aggressive, and unforgiving. In this video, we are breaking down what really caused this liquidation wave, who felt the damage the most, and why events like this reshape the market long after the price charts calm down. Stay with me, because what happens next could define whether this was a reset, a warning, or the beginning of something much bigger. The 2.4 billion shockwave that hit the market. This liquidation didn't creep in quietly. It hit like a financial earthquake. Within minutes, heavily leveraged positions were force closed as prices slipped past key thresholds. When margin requirements failed, exchanges automatically liquidated positions to protect themselves, creating a cascading effect. Selling triggered more selling, and suddenly billions were erased without time for manual reactions. What made this worse was timing. Low liquidity pockets combined with high leverage created a perfect storm. Once momentum shifted, there was no pause button. This kind of shockwave reminds everyone that crypto markets can turn ruthless fast, especially when traders mistake temporary confidence for long-term certainty. Who got wiped out first? Institutions or retail traders? The damage didn't discriminate, but the impact differed. Large institutions often used complex hedging models and diversified exposure, so many survived with bruises rather than knockouts. Retail traders, especially those chasing short-term gains with high leverage, absorbed the heaviest blows. Forced liquidations hit smaller accounts faster because they lack margin flexibility. While institutions usually plan for volatility, retail traders often underestimate how fast prices can move. This event exposed that gap clearly. It wasn't about intelligence or experience alone. It was about structure, capital buffers, and the ability to withstand sudden liquidation pressure without being instantly removed from the market. The role of high-frequency algorithms and artificial intelligence trading systems. Automated trading systems didn't cause the crash, but they absolutely accelerated it. High-frequency algorithms respond to price changes in milliseconds, executing trades long before humans can react. Artificial intelligence models detect momentum shifts, risk thresholds, and liquidity gaps, then act instantly. When selling pressure began, these systems amplified it by triggering defensive exits and short strategies at scale. The result was speed without empathy. There's no hesitation, no second guessing. While these systems increase efficiency, they also turn volatility into a force multiplier. This event showed how artificial intelligence can transform small price moves into massive market-wide reactions. Why leverage became the market's biggest enemy. Leverage promises bigger gains, but it also shortens your survival window. In this liquidation event, leverage turned normal volatility into destruction. Traders borrowed aggressively to amplify returns, leaving no room for price fluctuations. When prices moved just a few percent in the wrong direction, liquidation levels were instantly breached. That forced sales, pushing prices lower and triggering more margin calls. It becomes a feedback loop with no mercy. This wasn't about bad assets. It was about fragile positioning. Leverage doesn't forgive hesitation. And during moments like this, it proves why it's the most dangerous tool in crypto trading. Bitcoin's critical price levels. After the liquidation, once liquidations clear out weak positions, price levels suddenly matter more. Bitcoin often finds temporary stability after mass leverage flushes, but only if key supports hold. Traders now watch previous consolidation zones closely because these areas decide whether buyers step in or fear deepens. After events like this, volatility can either cool or intensify, depending on volume confirmation. If Bitcoin stabilizes, it signals confidence returning slowly. If levels break again, the market prepares for another wave of forced selling. These moments act like crossroads where the market decides between recovery momentum or extended fear-driven movement. Altcoins under pressure. Why smaller tokens suffer. More altcoins always feel liquidation events more aggressively, and this one was no exception. Smaller market caps mean thinner liquidity, so large sell orders move prices faster and further. When Bitcoin dips, altcoins often drop harder because capital rotates out quickly. Many altcoins are also heavily used in leveraged trades, making them prime targets during forced liquidations. Without deep order books, they struggle to absorb shock. Even solid projects can fall sharply in these moments. This doesn't always reflect fundamentals. It reflects structure. After liquidation waves, altcoins usually take longer to recover trust, volume, and directional stability. Stablecoins and liquidity stress signals. Stablecoins act like pressure gauges during panic. During this event, rapid inflows and outflows revealed fear-driven capital movement. Traders rushed into stablecoins to preserve value, while others moved funds off exchanges entirely. Brief deviations from pegs signaled liquidity strain, not collapse, but enough to raise concern. These moments expose how tightly confidence and liquidity are linked. Stablecoins didn't fail, but they showed stress. When trust shakes, speed matters. Large, sudden shifts remind the market that even assets designed for stability rely on smooth liquidity, disciplined reserves, and calm user behavior during extreme volatility. Exchange risk exposed in extreme volatility. Events like this always stress test exchanges. Order book gaps, slippage, and temporary outages magnify losses beyond expectation. Some traders exited at far worse prices than intended because liquidity vanished instantly. Automated systems executed liquidations without regard for impact, creating cascading inefficiencies. While exchanges functioned as designed, the experience exposed vulnerability in extreme conditions. Traders often assume execution will be clean, but volatility rewrites the rules. This reminds everyone that platform risk matters just as much as asset risk. Choosing where you trade, not just what you trade, becomes critical during moments of market-wide chaos. Whales are watching, accumulation, or another trap. Large holders move differently. After major liquidations, whales often wait rather than rush. On-chain data frequently shows increased activity, but not always immediate buying. Sometimes it's quiet positioning, sometimes preparation for deeper moves. Accumulation after forced selling can signal confidence, but fake stability traps impatient traders. Whales understand that sentiment takes time to heal. Their moves are calculated, not emotional. Whether this moment becomes accumulation or another distribution depends on follow-through, not candles alone. Watching wallet behavior provides insight, but never certainty. Smart money prioritizes patience when the market is still emotionally unstable. Artificial intelligence market sentiment tools. Turning bearish sentiment analysis has shifted noticeably. Artificial intelligence models tracking social chatter, on-chain flows, and volatility metrics have tilted bearish following the liquidation. Fear indicators spiked while risk appetite dropped sharply. These tools don't predict emotion, they measure it. Right now, they show caution dominating confidence. That doesn't mean collapse is guaranteed, but it does signal hesitation. When sentiment models align with declining leverage, markets often slow before choosing direction. Artificial intelligence doesn't replace judgment, but it highlights collective psychology at scale. After an event this large, the data confirms what traders feel. Uncertainty is firmly in control. What history says about post-liquidation recoveries. History shows that massive liquidations often reset markets, clearing weak hands and excessive leverage. Short-term volatility usually follows, but relief rallies aren't guaranteed. Some recoveries begin quietly, while others fake strength before falling again. The key pattern is reduced leverage and calmer price action before trend continuation. When liquidation events exceed $1 billion, markets typically need time to rebuild trust. Emotion fades slower than price. Past cycles remind us that patience outperforms panic. Recovery depends less on headlines and more on participation quality. Sustainable moves require conviction, not forced buying, driven by fear of missing out. What smart investors should focus on now. After chaos, clarity matters. Smart investors aren't chasing rebounds blindly. They're watching structure, volume, and leverage metrics. Reduced open interest and balanced funding rates signal healthier conditions. Capital preservation becomes priority over aggressive positioning. This is a time for strategy, not emotion. Observing how price reacts, not predicting it, provides better signals. Liquidation events strip illusions from the market. What remains is opportunity, but only for discipline. Risk management, patience, and realistic expectations separate survivors from repeat victims. This moment isn't about speed. It's about understanding where risk reset and where genuine strength begins to quietly return. This $2.4 billion liquidation wasn't just another crypto headline. It was a reminder of how fast confidence turns into chaos when leverage, automation, and emotion collide. We covered who took the biggest hit, how artificial intelligence systems intensified the move, and what signals really matter going forward. Moments like this shape the future of the market. If you found this breakdown useful, show your support by liking the video, sharing your thoughts in the comments, and subscribing for deeper, real-time market insights. Stay sharp, because in crypto, the next move is never far away.